I spend a lot of time searching social media before I invest with someone. And I mean, social media is a highlight reel in some ways, but there are definitely things you can find that you might decide you wouldn't want to invest with that person because you're investing not just your money, but I mean you're investing everything.
I mean, it's almost like a marriage, a 5 year long marriage or whatever. You're tied to those people. You're not getting out. Even as an LP, they're holding on to your money. It's like you're there, and those people are responsible for your money for 5, 7, 10 years or whatever. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend, business partner, and co-host, Frank Padalano, with me here today. As always, how are you doing, Frank?
Another great day talking about money.
Yeah, or at least the theory on how to make money, right?
There you go. There you go.
One of my favorite sayings as an engineer is, in theory, there's a difference in practice and theory.
Absolutely.
So the last episode we talked on is we started on how to vet operators or sponsors or people who are bringing you deals, and they either want your investment money as like an LP or they want you to be part of their GP team. And so we were going into how do you vet those teams. Um, is actually quite a big topic, and so this is now part two of that same topic. Um, time we went into how or what questions should you ask the team? Uh, do you have boots on the ground? Who's going to be running the asset, property management, all that? And if you want to learn more, go back to the previous episode. This episode, we're going to carry it further. And some, so what I want to talk about today is like, what are some, not necessarily lies, but what are some excuses or possibly falsehoods or misdirections do teams tell you that you should be looking out for? And I don't want to say lie because most people don't intentionally lie, but they usually try to sugarcoat things and stuff like that. So, you ready to jump in?
Absolutely.
Do you remember the last episode? I remember it.
Yeah, yeah.
So, one thing that I've seen, and my wife Angel has seen numerous times, she's gone to conferences and she's talking to people who've been on like 30 teams. They've raised capital for 30 different properties. Yet she asked them a simple question of, are those 506B or 506C? And they had no idea what she was even talking about. So, having been on 30 teams, having like $60 million in assets under management, having 2,600 units or whatever. That all sounds nice and glorious, but do they actually run the asset? Or the person you talking to run the asset, or is he just someone who shows up for the monthly meeting, maybe decides on what playground equipment to get, and it doesn't really affect the day to day, or isn't involved in overseeing any of the management or whatever? Have you seen that before, Frank?
Unfortunately, way too much. I do have a number of people that I know. So I'm a GP in 10 deals right now. And out of those 10 deals, I feel that I have a pretty good handle on about 7 or 8 of those deals of what's going on all the time. And it's easier just because the meetings are in the right spot, and I try to attend all the meetings, and most of them are weekly meetings. But yeah, the whole concept that if they can't answer some basic questions, um, that's usually a problem. I mean, sometimes if it's a tougher question, you might have to check with someone else in the team, and people do have different roles. But you should definitely know what's going on in the deals. And like you said, assets under management. There's a difference between being a 5% or a 10% or a 20% of a general partnership and being like 3/4 of 1%. So
Mhm.
it's just like doors. I mean, some people are big on the door count. I don't even worry about the door count at all. I actually care about how many deals they're actively a part of. So like, so we have a boutique hotel, as you know, and there are people that are part owners of things. It's like, yeah, but then like our hotel, it's a small hotel, but we're actually in the day-to-day operations and we own it outright. So we have no mortgage on that. There's no leverage. So I have a lot of money, time, and everything else riding on that one deal. So obviously, if you're putting a lot of time, effort into things, that has more value compared to if you're just like a small piece of something.
Yeah. And I mean, I used to, when I first started out, I used to like, oh, I'm invested in 3,600 doors, but, and this is just an LP. I mean, I was just young and naive. Everybody was talking about door count and stuff like that. It's like, yeah, I put $25,000 into a fund that was buying like 1,500 doors. So, I mean, right off the bat, I'm 1,500 doors in. It's like, yeah, it doesn't really work that way. And you shouldn't be using that as a metric.
Yeah, so the
Um,
way I say it is I think of it like stocks. My daughter, who owns some shares of Wendy's, she owns like 10 or 12 shares of Wendy's stock. We don't go around and say, hey, we own part of 3,000 Wendy's,
yeah.
especially when it's a small percentage ownership like that. So those are just things you have to think about when people inflate their track record.
Yeah. I mean, technically, she could go and say she owns 3,000 Wendy's or part owner of it, but I mean, it's the same thing. It's people conflate their numbers, they inflate them, and they're just trying to make them sound better than they actually are. And so that's one way that they don't try to deceive you. They're just trying to like puff up their chest, say, "Look how good I am," but they're not. They're doing themselves a disservice, I think, and they're doing their investors a disservice as well. I mean, when Angel was talking to those people at the conferences who were in 30 different deals and raised some money or whatever, and they asked her what she was doing, and at the time, I think she only had like raised 2 million and had two properties under her belt. It's like, but those two properties, she was the lead sponsor on, or we were all the lead sponsor on it, and we run the day to day. We're in the meetings every week, and there's a whole lot different than, like you said, being involved versus just claiming partial ownership or whatever. So
You remember the call yesterday where we're at 88% occupied on that property. I told our property manager to send me an email, and I was listing them on Facebook Marketplace, individual units.
yeah,
Those are the little things to show the difference between someone that's really part of the deal and someone that's like, oh yeah, I'm on a call.
yeah. And then there's also the time. People say, well, I've been doing this for 20 years. I've been doing it for 5 months or whatever. Um, what have they been doing for 20 years? I mean, I've been in real estate. I've been investing in real estate for over 20 years, but I've only been in commercial real estate for maybe the last 5 or 6 years now, maybe seven. Um, and I've been in mobile home communities for negative 6 months, hopefully. I say negative because we're developing one. I've never developed one, and never owned a mobile home community. But we should hopefully be mobile home community owners in about 6 months, based on the development. Actually, I think it's 8 months. So
We better be
negative eight
breaking
months.
ground, or I'll have to take another flight out there.
No, we will. No, I'm saying up and running within 8 months. So,
Nice, nice.
um, this one we talked about a little bit briefly on the last one is distributions and delays. Um, but really, you need to. We talked about how the sponsorship team handles them. Um, but let's go into like some of the misdirections or excuses on why they're not doing them versus it's like can they do them and just choosing not to, or are they not able to at all and actually going to be doing a capital call on you. So I mean, a lot of things, especially a few years ago, right before interest rates started climbing, people started like not distributing, or they're withholding, just to see like what the market was going to do. And they call it, well, it's just a temporary market softness or something like that. And so they were holding on to it. I mean, it's not a bad practice, but I think the message that they were sending was wrong. It's like, go into the specifics. Don't say, oh, there's just a temporary market softness. That doesn't mean anything. Say, well, we might be over leveraged. Interest rates are climbing, and we didn't get the rate cap like we were hoping to, and so now our interest rates are climbing greater than anticipated. But we're trying to buy a rate cap, and so now we're saving up a bunch of money to do that. So that's one reason. It's a good reason, because I mean they're trying to prevent it from happening further. It just costs a whole lot of money up front. So
Part of it has to do with, communications. So obviously, if you have a property that's not performing, I would say it's better to communicate more than to communicate less. People don't always want to hear the answer, but they still need to.
yeah,
I mean, there, like we've said before, there are many deals that are not performing right now. People have faith in you. People put their blind trust and their money into the deal. And if it doesn't make money, that's one thing. If it doesn't make money and you're not even telling them why, then that's a different thing.
yeah, and you just need to put your message out, like you said. Communicate. Over communication is better than under communication. But the people, your investors, they're going to take the amount of communication that they need. So if you're sending out 20 emails a day, giving them updates on everything, they're going to read one a week, and that's all the update they need. They're not going to read 20 emails a day or whatever. Or maybe they'll read one email every few months. That's the amount of communication that that person wants, but the communication is available if they wanted more. Does that make sense?
Yeah.
Because I
I mean,
mean, how many?
I'm an LP in so many deals. I got to be honest with you. I don't even read the emails most of the time.
Yeah, it's like, how many emails go unread in your inbox? I mean, my right now, my email has, and I haven't archived lately, 23,915 messages. So,
Yep, I'm the same way. My promotions, which includes some emails from syndication LP teams, it says 28,000 unread. So
yeah. So your investors will take the amount of communication that they need, so long as it's available. But if it's not available and they need something, that's when they start getting upset. So, another issue or reason or excuse is property management company dropped the ball. It's like, you and I know firsthand that this can happen. We've said many times that your deal is only as good as your property management, and but you can't put all the blame on them, because your job as the operator is to manage your property management. So if you're watching occupancy drop from the 90s to the 80s, go from high 80s to mid 80s to low 80s and to upper 70s over a course of 3 or 4 months, and you're just sitting there watching it happen, you're dropping the ball. Yeah, management is not doing what they're supposed to, but you are dropping the ball because you're not on management's behind the way you should be. Maybe you need to get new staff. Maybe you need to hire a new property management all to begin with. I mean, there's more to just blaming somebody, because rarely
yeah,
does it go from straight from like 95% occupied down to 75% in a month. I haven't seen that.
I haven't
It,
seen that
it,
either.
so
Um, yeah. So for example, our property in Idaho, we're on our third property management company since we bought it. And one of the things I've definitely said on other podcasts before, even though I have many friends who are property managers, is that all property managers suck. They just suck differently. So there's different things that property management companies are good at. And one thing that the average property management company is not good at is that if there's no problems, sometimes they rest on their laurels a little bit. If I have property management companies that don't like to push rents, even if they should be, because they don't want to deal with vacancy.
or they don't want to deal with residents' complaints.
Well, that's
Because
true too, but they don't want to deal with the turnover. They don't want to deal with the evictions. They don't have to deal with a lot of things. It's like, well, I understand that, but
That's your
You
job.
guys signed on to property manage this property, and we had a budget to start with, and especially if there's breathing room. Now there's some places, especially right now in the market, where rents have stalled completely. But there's definitely other places that I'm involved with that our property is still $100 or $200 a month below market rent, and the property management company is still not trying to bump up rents at all. And it's like, guys, I'm not making any money on this property. I'm actually losing money. We need to work on this game plan. So
Yeah. And we can go into property management issues probably in another episode where we just talk about property
yeah,
management. Um, because I have some stories and anecdotes too, but that's a tangent off of today's topic. So, one that I've seen firsthand and one we've actually done is refinance is coming. So we're holding distributions because we Frank and I have been working on a refinance for going on 6 or 7 months now. Every time we get a loan product, for some reason, the lender bails on us and leaves us high and dry after we've been spending months working with them. And so I've seen this one firsthand that a refinance is coming any day. And we are hoping that the loan proceeds will cover everything we need, but we are holding a reserve just in case we have to pitch in 100K or 300K or whatever. I know when we first started looking at a refinance, we were looking at loan proceeds that were coming in 800K shorter than what we owed on the loan, much less all the fees incurred from closing again. So, I mean, this is understandable. Um, and it has been going on for months. It's not ideal. But this is why you need to communicate. Say, hey, we've tried this loan product. We've tried this loan product. We've been working with this people for 2 months, and then they bailed on us, and then we had to try something else. You again need to over communicate rather than under communicate in this regard. So
I see both sides on this, only because I'm not going to blame some operators on that. From my own personal experience, just the concept of how much your hands are tied by these loan brokers, of these lenders. So, I mean, every time I'm told that a deal is going to be able to close in 2 months or 60 days, I just laugh because I don't remember the last time I saw a loan close in 60 days. It sounds funny, but yeah,
and also it's like, well, we should be expecting the application at the end of the week or first thing next week.
yeah, that's
How
two
how
weeks ago.
many weeks have we heard that?
Yeah, yeah.
I mean, we heard it for every single loan product that we were going after, and then right when we're supposed to get it, oh, sorry, we're overexposed in Texas, and we're not gonna be lending on anything now. So it's like, yeah.
So, what's some examples of things that you do, Jason, with due diligence when you're considering investing with a new team or speaking to a new operator or general partner?
So one, I have a due diligence checklist on my website. Um, It is called I should know this offhand. It's ironcladunderwriting.com/resources. And you can find a due diligence checklist. And it's probably overkill for 90% of the deals out there. But what you need to do is you can go through it and you can see what pertains to that property that you're looking at. And then you can just start asking the team, it's like, have you looked into this? Have you looked into that? Um, let's see, I called it DEC, Deal Examination and Confirmation Key Points, the due diligence checklist. It's like I said, ironcladunderwriting.com/resources. And you need to be able to ask, have you checked, have you done your lease audits? Have you walked every single unit? Stuff like that. And then you need to, one, see, like, hopefully they're not just doing this over a phone call, maybe a Zoom call or in person, see their body language, see if they're trying to hide anything. And because a lot of times people say, yeah, we've walked every single unit. Of course, they're like investing in a 400 unit property and they only walked 95% of them. 95% is not the same as walking every single unit. Um, so I mean, there's just you need to just, if you ask them a question need to be able to answer. If they don't know the answer, they need to be able to look it up. And like a lot of PSAs or the purchase sales agreements will have due diligence period on there saying, well, you can do due diligence from signing the contract in 30 days and then the money goes hard or whatever. Right. Due diligence does not stop after that day. You continue due diligence up until you close. You can look and investigate. Yeah, you might not be able to get out as easily or you lose some money, but you still need to keep investigating the property as best you can, especially if investors asking you questions you don't know the answers to.
I mean, that's absolutely, even on smaller properties too. We had a deal where we were trying to buy a 5 unit, and come to find out it was only legally zoned as a duplex. And we ended up walking away from that deal. We only found that out 3 days before closing. So
Ouch.
yeah. So the good news is we really hadn't spent a lot of money on it, but I definitely moved a lot of money around to do that deal. Let's put it that way.
Yeah.
Yeah. So when we're talking about due diligence here, I was thinking more due diligence on who you're investing in and who you're
Oh,
investing
okay.
with. I spend a lot of time searching social media before I invest with someone, and I mean, social media is a highlight reel in some ways, but there are definitely things you can find that you might decide you wouldn't want to invest with that person. Uh, just like the concept of being a big network. So I usually try to talk to other people, either referenced from them directly or just mutual friends saying, "Hey, have you ever done a deal with them? What do you think? This and that." So because you're investing not just your money, but I mean you're investing you everything with them in that deal. You
Yeah.
know.
I mean, it's almost like a marriage, a 5 year long marriage or whatever. You're tied to those people. You're not getting out. Even as an LP, they're holding on to your money. I mean, it's not a liquid investment where you can just tap into it anytime you need. It's like you're there, and those people are responsible for your money for 5, 7, 10 years or whatever.
I'm laughing that you call it a marriage because I don't know if you ever heard me say this before, but I joke that I have a lot of partners, and I said my partners are kind of like sister wives. So
But going back to what you said about due diligence on the team itself, um, I have the benefit of being married to Angel Williams, who like loves reconning people, loves reconning teams, and she has a vast network that also love reconning people. And so they're always bouncing people and teams off of each other. It's like, what have you heard of this person? What have you heard of this person? It's like, well, stay clear of this. It's like, well, I haven't heard anything bad about this person. I haven't heard anything good either. But usually, if you hear something bad, it's like it's widely known in that little group. So
well,
if there's someone's not widely known in that little group, it's probably a good sign. So
I mean, angels saved people tens of millions of dollars. So yes.
yes, and some people on that group actually do background checks on the people without you even knowing. So they'll do a background check. And the funny thing is he did background checks on Angel and me, and so to see if he even wanted to work with us. So he's working with us. So I guess we passed.
There you go. Yeah, so something else to think about is when you're looking at their business plan, especially after it's already started, and they may have been either too aggressive with their rents, or for some reason or another, they are not hitting the numbers that they wanted. Lucky for me, most deals that I'm in, it's not a rent increase problem. It's more of a expense increase problem.
Yeah.
So the rents usually for most of my deals, the rents are well in excess of what we expected. But the problem is that the expenses have gone up much faster too.
Yeah. I was involved in one deal. Like their business plan looked good. Everything looked good. The numbers look reasonable. The rents look reasonable. Expenses look reasonable. And actually, everything about it was reasonable.
But
But what happened was they didn't raise enough money. They were supposed to raise like 21 million or something. They ended up raising like 18. And that other 3 million was going to go toward the capex budget on the property. Okay. What they did was they didn't raise enough. They still took the acquisition fee, which you and I are on the same page on. If you don't raise enough, you don't take an acquisition fee because you didn't do what you said you're going to do to begin with. Um, or you don't take the acquisition fee until you raise.
Yep.
But they never raised and they stopped raising, but they carried out their capex and they used their cash flow that they're getting from the rents to fund the capex.
I mean,
So
there's worse things. At least they were using money to finish the capex. They should not have given out acquisition fees. I'll agree with that.
yeah, and there's like 400K in acquisition fees or something
Oh,
crazy
yeah,
like
yeah.
that.
So we're dealing with a similar situation right now. We have a property that has not fully raised. It's a 506B, so you can't do any more with, our network's already dry. And we did give 25% of the acquisition fees, but we gave it early, thinking that we were going to still be able to raise. I've put more money in, and once I sell a property, I'm probably going to be putting six figures into that because every unit that is redone is a unit that we can make money on. Right now, those
Yeah,
units are just sitting there, and it's getting painful.
yeah. Um, and also on that team that I invested with, what I didn't mention yet was the people carrying out the capex. What the one of the sponsors had a construction firm, and
Oh yeah, you didn't say that.
he was paying himself on the construction side to carry out the capex. Now,
I know this deal now. We won't mention any names.
being vertically integrated is okay if it's done properly and you're upfront about it. But if you try to hide stuff, um, because what happened was that construction team started and did about half of the capex originally planned, and then they went and hired somebody else, which to cover because like the whole thing was kind of shady. Um, but when you ask the team about it, everything was going to plan. Rents are coming in, stuff like that. But they never mentioned that they didn't raise enough. They'd never mentioned that they're funding capex through the cash flow. All they're sending you is a monthly statement saying, "Look, we're getting this month in rent. We're getting this expenses. We're at a 45% expense ratio. We're doing really well." That's it. It's like, well, where the hell's the money? It's like there is no money. So that's another way that they can try to deceive you, or they don't want to be as transparent as they should. So,
How about being conservative with exit strategies?
so exit strategies. We've had a conversation on exit strategies a few episodes ago, and yeah, exit strategies can change. Times change, interest rates change. That has a bearing on a lot of stuff. So you need to be able to ask, say, hey, what's the plan? And they should be able to tell you what their current exit strategy is. It's like, well, we were going to try and refinance, but maybe it's better to sell and refinance. Yeah, I could have taken quote unquote 60 days, but maybe if we're selling, it's going to take 180 days because you have to put it on the market and you have to get a bunch of people to look at it and then go through the whole process of that. Um, so they should at least tell you, yeah, we were trying to refi, now we're going to sell, and so it's going to look like hopefully we'll get our money back in 6 months versus another 4 years, but we might not get as much as we wanted just because we're selling it at a little bit less than what we intended to do or whatever. So I mean, or maybe you were intending on selling but nobody's putting in offers, your loan's coming due, so you have to refinance. So you're going to refinance into something else, and you're going to hold it for a little bit longer. Everybody on that team should know what's going on with that in that regard. Everyone on the GP team should know, hey, we're trying to refinance this because the sales is going to fall through or whatever, you know. So they need to be able to communicate that to you, and like you mentioned before, everything is about communication. It's be transparent, communicate, and just lay it all out there. I mean, they're your business partners. Why are you trying to hide from them? You know? Have you seen anything on exit strategies? Any miscommunications
I mean, I see it
or
more on the underwriting side than actually when the plan is going through. On the underwriting side, whenever they have um, a sale 5 years from now with a compressed cap rate, when who nobody knows what to predict when 5 years from now. So why would you
Yeah.
compress it?
Yeah.
Another thing, I mean, I have seen deals that more on the successful side where they were worried about future market conditions. So the good news is they sold for a profit, but they sold super early. You know?
Yeah. I have seen projections, and I think it's from CoStar, where they are predicting cap rate compression on some markets. And I've as a consultant, these people came to me and say, "Hey, this is what we're projecting for a cap rate." I was like, "Okay, you're going in at a 7.5, and you're projecting it's going to be a 5.75 on sale. You realize that's going the wrong way." It's like generally, I'd like to see cap rate expansion, at least in my underwriting, and then if there's any compression, it's like a bonus. It's like gravy. It's like woohoo! But you need to at least plan for the worst. But
Absolutely.
these people weren't, and it's like, all right, I'm telling you right now, this is one of my red flags. You can do with it what you want. If your risk tolerance is different than mine, and so be it. I'm just telling you what I'm finding. So, um, so this and probably we've only gotten through, I guess, another third of our list. So we could probably end here and start up another one just to give the listeners a break so that they don't have to keep listening to us. We'll
Just,
continue
just
on with how to vet a deal in the next episode.
yeah,
What is that?
definitely. I just want to say right here though that I love syndications. I love being a limited partner on deals. I love being a general partner on deals. Do people make mistakes? Yes. Are we trying to scare you out of this type of investing? No. We're just trying to help you be informed on
Yeah.
what to do in certain situations, and just so you have knowledge for the future.
Yeah. And a lot of our stories are like the worst case. When we have like a good investment going, good team with good communication, there's really no story to tell. It's like, yeah, I gave them my money and I got 2 times it back in 5 years and I got 8% cash flow, just like they said. It's like, what else is there to say? I mean, yeah, I would invest with them again, and this is people I invested with. If you want to do it, I was like, that's how the good stories go. With the bad ones, you like to get into the nitty gritty and say, oh, how horrible it was and everything, and that's what we're doing here. So,
Yeah, yeah.
yeah,
No,
we're
I mean,
we're
now
not
that you
trying
say
to
that,
scare you.
I mean, we have a deal in Massachusetts. We bought a year and a half ago, and after 13 months, we refied, and everybody gets 75% of their money back, and they get distributions every quarter. And I don't hear any complaints, and everybody's excited, and we're gonna keep moving forward. And it's a super easy deal because there's $700,000 sitting in a bank account, ready for future problems. So yeah, it's always a great day when
Yeah.
you get the right
So
deal.
yep. So catch us next episode. We'll go into part 3, and we'll catch you later. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.